We're going to look at an example where we had some fixed assets at the beginning of the year, and then we also purchased some assets during the financial year. So it says that on the 1st of March, the following balances appeared in the books of Robin Traders. So on the first day of your current financial year, you had the following balances. So you had some vehicles, you had some equipment. Then you also had accumulated depreciation on both those assets. So this means that you owned these assets prior to the current financial year. Okay, so because it says on the 1st of March, it means that this is what you started with in the current year. And because you already have an opening balance for accumulated depreciation, it means that you have now already written off some depreciation in the previous financial years. So I always say split your calculations. So you have your vehicles and you have your equipment. Now we're going to split these even further. We are also going to now say that we had old vehicles and we also had old equipment, meaning the assets that we had prior to the current financial year. So not purchased in the current financial year. Then we had a cost for our vehicles of 540,000, and we had already accumulated depreciation of 135,000 on those vehicles. Then for our equipment, we started with a cost of 342,000, and we had already accumulated by day one of the current financial year, we had already accumulated depreciation on those. Then additional information. So please just note, we no longer use checks. We now use EFTs. So we're definitely not working with checks. So it says that during the current financial year, a new vehicle and some equipment were purchased and we have paid for this. The following information relates to the transactions. So you have for the current year also new vehicles that you purchase at a cost of 216,000. And remember, there's no accumulated depreciation on new assets because you can only start accumulating depreciation after owning it for a few months in your current financial year. Then new equipment with a cost of 81,000. And then once again, no accumulated depreciation there as yet. Okay, then we're moving on. The vehicles were purchased on the 1st of May 2019. So your financial year ended 29 Feb 2020. So you owned this vehicle, this new one, you owned it for May 2019. So May, June, July, August, September, October, November, December, Jan, Feb. So for 10 months in your current financial year. The old ones you have owned since day one until year end, so for 12 months. Same thing with your old equipment. You've owned it since day one up until year end, therefore 12 months. The new one you only purchased on the 1st of Jan, so you only had it for Jan and Feb, so for 2 months. Then depreciation is written off on vehicles using the straight line method, so 15% on cost. And then for my equipment, it is 20% using the carrying value because they said that this is on the diminishing balance. Right, so now I have all my information. So for my first vehicles here, the old ones, 540 times the rate times time. So for 12 over 12 months, I owned those vehicles. Then for the new one, 216,000 times 15% on cost for only 10 out of the 12 months. Then for my equipment, I first need to calculate my carrying value, and that is the 342 cost minus the accumulated depreciation on day one. Once I have that, I'm going to multiply that by 20%, and then I had these items for the full financial year. Then on the new one, I had no accumulated depreciation on day one. Therefore, my cost is equal to carrying value, or then carrying value is equal to cost times 20. And I only had these assets for 2 out of the 12 months in my current financial year. So let's go. Calculator time. There we go. So the old ones, 550. 540, not 50, times 15% for the full financial year, so 81,000 Rand. Then at this point, you must just double check that if you now add your accumulated depreciation, it must be at least 1 Rand less than the cost, because you're only allowed to write off an asset until it has a carrying value of 1 Rand. But we are still fine because it's only 216,000 now and cost is 540. Then for the new ones, 216 times 0.15 for only 10 out of the 12 months, so 27,000. So in other words, the total depreciation on vehicles is your 81,000 plus your 27,000. So it's the 81,000 plus the 27,000, so 108,000 for my vehicles. Then for equipment, first calculate your carrying value times the rate, and you had this for the full financial year, so times 12 over 12, and that is 43,776 Rand. Then you also purchase some new equipment, also depreciation at 20%, but only for 2 out of the 12 months. So that is then 2,700. So therefore, the total depreciation on my equipment was 43,776 plus 270. So 46,476 Rand. So I'm going to debit my depreciation account. And I'm going to debit the depreciation account with the accumulated depreciation. What did I type there? Depreciation on vehicles, first of all. And that was 108. So it's a total of the old and the new. And then with the accumulated depreciation on equipment. And that is 46,476. So with the total of that, so I have 108 plus 46, so 154,476 that I'm debiting my depreciation with. So this is my expense, and then my credits will go to the individual accumulated depreciation accounts. So if you then have to calculate the total accumulated depreciation on vehicles, you're going to take what you started with, your 135, and you're going to add to that your 108 to get your total accumulated depreciation, so the balance at year end. Then the balance at year end for your equipment is therefore your opening balance. So opening balance plus my current year's depreciation that I'm adding onto that to get my balance. And then also you'll see if you now add your 123,120, so your starting balance plus the current year's depreciation on those assets, it is still less than your cost. So you are still good. You do not now carry a negative asset, because obviously we're not allowed to do that. Okay, so that is depreciation if you start with assets at the beginning of the financial year and then you purchase more assets during the financial year.